and welcome to the Macro Financial Review press conference. This is the first of two macro financial reviews that we publish every year. Just some introductions. To my left is Ed Sibley, the Director of Banking Supervision, also a member of the ECB Supervisory Board. Sharon Donnery, our Deputy Governor for Central Banking. Maurice Maguire, who is in a new role as the Director of Financial Stability, and Mark Cassidy, who's the Head of the Financial Stability Division. So we'll open with some remarks from Sharon. You should have received some of these under embargo, and then we'll open to questions. So I'll hand over to Sharon. Thank you.
Thanks very much, Jill, and good morning, everyone. So as Jill mentioned, today the bank is publishing the first edition of the 2017 Macro Financial Review, which provides an overview of the current state of the macro-financial environment in Ireland. And the review aims at supporting the bank's stakeholders, including the public, national and international authorities and financial market participants in their assessment of financial risks. It also provides an opportunity to promote an informed dialogue on the macro-financial environment in Ireland and beyond, thereby contributing to the bank's mission of safeguarding stability and protecting consumers. So the global economy is expected to grow modestly in 2017 and 2018. However, the UK leaving the EU and the possibility of changes in international tax and trade policy are among the key factors generating uncertainty at this time. Although measures of implied volatility in financial markets remain at low levels, risk and term premia are compressed, with the potential for an abrupt change in investor sentiment arising. European banks, insurers and pension funds remain vulnerable to such shifts in market sentiment, in addition to structural and cyclical challenges. And in this context, high stocks of non-performing loans arise in some member states' banking system, while banks need to diversify their profit sources and address overcapacity. Turning to the domestic environment, while the Irish economy continues to expand at a healthy pace, the degree of uncertainty surrounding the outlook has increased since the last review. The short-term impact of Brexit has largely been felt through the exchange rate channel. In the medium to long term, any new trade barriers faced by Irish exporters to the UK will likely have a significant impact on their activity, principally in sectors such as agri-food and manufacturing. We welcome that the European Council guidelines for the Brexit negotiations outline specifically that any future framework should safeguard financial stability in the Union. Domestically, infrastructural deficits, particularly in the housing sector, may prove to be constraints on growth over time. Brexit is expected to have a material impact on the non-financial corporate sector, and its effect is likely to be felt through changes in UK demand, in addition to the exchange rate developments and a potentially more restrictive trading environment. Although new lending is increasing, year-on-year growth in bank credit to both the household and non-financial corporate sector remains negative. Against this backdrop, the counter-cyclical capital buffer rate on banks' exposures is maintained at 0%. The counter-cyclical capital buffer, as you may recall, is a time-varying capital requirement which applies to in-scope banks and investment firms. It's designed to make the banking system more resilient and less pro-cyclical. Essentially, the CCYB will increase the capital requirement of banks if we see credit growth becoming excessive. It can then be released, partially or fully, either in the case of a period of systemic stress or when credit growth and associated systemic risks recede. The review shows that credit growth to SMEs remains negative across all subsectors as firms continue to deleverage. New lending to SMEs, however, has been rising since early 2014, and a large decline in non-performing loan rates across all categories of SME and corporate loans has been evident in recent years, although more than 10% of these loans are non-performing and there is substantial sectoral variation in NPL rates. Some categories of household credit are showing positive growth, including non-mortgage credit and mortgage lending at fixed interest rates. The overall rate of growth in mortgage loans remains negative as floating interest rate mortgage lending continues to fall. While household debt has been declining, the sector remains highly indebted at €143.8 billion in Q4 of 2016, leaving it vulnerable to a rise in interest rates. Those in the 30 to 44 age category have a high debt-to-income ratio relative to other age cohorts and by international comparison. The overall number of mortgage arrears cases has declined by 44% since Q2 2013, although almost half of mortgage arrears cases are now very long-term arrears. Turning now to Irish commercial real estate market, 2016 continued to see high total returns. The commercial property vacancy rate was 13.5% in Q4 2016. It is much lower, however, for the Dublin office sector at 7% in Q1 of this year. A substantial amount of new office supply is under construction, being planned or at a pre-planning stage. The commercial real estate market has also seen a broadening of its investor base in recent years. The possibility of firms seeking to relocate to Ireland as a result of Brexit could add to demand, although Brexit could also have a negative effect, in particular on retail commercial real estate, if consumer sentiment is adversely affected. Existing commercial real estate exposures leave Irish retail banks vulnerable to any such change in market conditions. House price growth has been rising steadily since late 2016, while survey data show further price increases being expected over the medium term. High rental growth is also being observed. A scarcity of housing in certain locations is contributing to price and rental developments in the residential property market. There has been a substantial decline in vacancy rates in recent years, particularly in high population growth areas. The number of residential properties listed for sale or for rent is also low. There is some uncertainty surrounding official housing completion data at present, but the number of new units being built and likely to be constructed over the medium term is below demand. You'll recall that the bank introduced macroprudential mortgage lending requirements in February 2015. The outcome of a review of our requirements was announced in November 2016 and found that the regulatory framework is appropriate and effective in meeting the objectives of the measures, which are to strengthen households and banks' resilience to shocks and to curb price credit spirals in the housing market. And we have committed to review the measures on an annual basis. The general government deficit ratio continues to improve, and the medium-term deficit target is projected to be achieved in 2018. The public debt burden, at around €42,000 per person resident in the state, however, remains high by both historical and cross-country comparisons, leaving the sovereign vulnerable to real economy and financial market shocks. Looking at the financial sector, Irish retail banks' profits, while remaining positive, fell in 2016 as a substantial reduction in the write-back of impairment provisions occurred. Operating income increased last year, with the domestic market accounting for almost 80% of revenue. Brexit could adversely affect those Irish retail banks with a significant presence in the UK. New lending to the UK, for example, fell by over 18% in the 12 months to Q1 2017, with a drop in UK mortgage lending and exchange rate movements contributing. Irish retail banks' aggregate loan book has become more concentrated in recent years in residential mortgages and in lending to Irish counterparties. Developing a sustainable model to address declines in their main income sources and the eventual normalisation of interest rates represents a challenge for the Irish retail banks. The aggregate value of total assets held by the Irish retail banks fell by almost 5% year on year to Q1 of this year, while outstanding loans fell by almost 8% in the same period. Deleveraging, write-offs, loan redemptions exceeding new loans and currency movements have all contributed to this decline in loans. While credit exposures continue to fall, credit quality is improving, and the value of outstanding non-performing loans fell by over a quarter in the year to Q1 2017. The resolution of NPLs remains vital to the future health of the banking sector. The review provides more detailed macroeconomic, sectoral and system analysis, which we're happy to discuss with you now, and thank you very much for your attention.
Thank you. We'll now open to questions. Joe Brennan from the Irish Times.
Just, sorry, with regard to the incoming Taoiseach and talk of loosening fiscal policy, also talk of not using the rainy day fund to segregate a certain amount of money for a rainy day. What's your view in terms of those plans when the debt level is so high or remains so high?
Yeah, so as you mentioned, I think there have been much discussions about the debt level. It remains high both in absolute terms, by historic terms and in international comparison terms. I think the bank has been consistent about its position about the need for a prudent stance in relation to the public finances. One of the things I think on which there has been quite a bit of focus over recent times has been debt to GDP ratio and some of the measurement challenges around GDP because of these potential distortions due to the multinationals. And as you probably know, the Governor led this work on looking at alternative indicators, and we'll shortly have the Central Statistics Office publish this new national income indicator, GNI Star. So I think in the context of those measurement issues around GDP, we've also been quite consistent in saying that the kind of typical analysis of a debt to GDP ratio has some limitations in Ireland, and so we have to look at these other ratios, for example, forthcoming debt to GNI Star, for example, and so the kind of 60% debt to GDP ratio that other countries would normally look at is not really applicable in the Irish case. But overall, I would say we would strongly recommend a continuing prudent fiscal stance, particularly in light of the uncertainties that arise from Brexit and other issues.
Okay, we have another question, Sir Pádraig Halpin from Reuters.
Just in relation to the susceptibility of Irish households when it comes to interest rate rises, just wondering if you could talk through what the consequences of that would be. I mean, are we talking about potentially some in that 30 to 44 group falling into mortgage arrears, or is the big risk around disposable income going forward for those people?
So I think the backdrop to the discussion about interest rates is partly about the continuing high level of household indebtedness. I mentioned some of the numbers in my remarks there. And again, a bit like the discussion about the fiscal situation, household indebtedness, both in historic terms and by international comparisons, remains extremely high. You'll also be aware of other discussions we've had about the composition of mortgage lending in Ireland, the large numbers of borrowers who are on tracker mortgages or other variable rate mortgages, and so in terms of the products that they hold, they are vulnerable to this normalisation of interest rates, particularly on their mortgages, but potentially on other credit products. I think in terms of disposable income, this kind of general uncertainty in the economy, particularly around Brexit, and in some of our other publications we've given some indications about the potential negative effects on economic growth and so on from Brexit. Of course, that could spill over into disposable income as well and have a further impact on people's ability to repay mortgages. Because of the timing of the crisis and the high levels of indebtedness, as you mentioned, this particular category of 30 to 44-year-olds is a particular area of vulnerability, and we have published some other work in relation to those. I don't know if you want to add anything.
No, I think that's...
Okay, and then we go to Colin Kelpie from the Irish Independent.
Fiscal Advisory Council has warned about the potential for overheating, obviously with the housing sector a key risk. The OECD went one step further to say that the economy is overheating somewhat, is how they described it. Where does the central bank lie in this debate? How far up are we on the overheating scale as such? Thank you.
Yes, so I suppose I mentioned two aspects there in my opening remarks. Firstly, in terms of credit growth, which while we see some pockets of growth emerging in credit, particularly, for example, fixed rate mortgages now are increasing, the overall situation in relation to credit, I would say, remains subdued. I also mentioned in my opening remarks the situation in relation to house prices, and I think there's been quite a bit of public debate about that in recent times. I would recall, as I did in my opening statement, the macroprudential measures, the borrower-based measures. I think it's very important when you think about this issue that you look at the objectives of those measures, which are to build resilience for both households and for banks. And they are also intended to stop this issue which emerged during the crisis of prices and credit developments kind of reinforcing each other in a cyclical way, hence leading to some bubble issues. The bank is acutely aware of those issues, and I think all of the analytical work that we presented as part of the review of the measures last November deals with considering those issues, and they will of course be considered again in the context of the review later this year. I think it's important to emphasise in relation to the review that we want to be clear about periodic reviews. We don't want to be responding to individual increases or decreases in particular data points, and so we want to have an appropriate period in which we can look at the various developments and so that review will be published later this year. If you think about wider issues, I think about the economy and other aspects of potential overheating, not necessarily just related to credit. We have, from a banking system perspective, other tools like the counter-cyclical capital buffer, which I mentioned, which apply more broadly to wide credit rather than just residential mortgage credit. And as I said to Joe, I think our expectation would be that the fiscal position should remain prudent to ensure that in aggregate these risks are well understood and well monitored.
Sean Whelan, RTE.
Thank you. The OECD also used the B word last week, bubble, signs of a bubble emerging in property market in Ireland. What do you think of that view?
Well, as I said, our I suppose current analysis is that from a credit perspective, overall credit conditions remain subdued. We're certainly monitoring developments in house prices very carefully, and will continue to do so in preparation for the review in the autumn.
Yeah, I suppose just one other metric we would look at will be the level of house prices compared to where we think maybe they should be at this stage, our economic performance. And the work we published at the end of last year, we will be updating this year, would suggest that house prices are not currently overvalued. So that, together with the credit situation, I think is important, albeit that house price rises are quite strong at the moment.
Any other questions? Joe Brennan again. Thank you.
Just looking at MPLs and Brexit, are you guys seeing, or are the banks seeing any increase in terms of, particularly with SMEs who would be exposed to Brexit, any increase in defaults or non-performing loans in those categories?
So Ed might say something in a minute, but I suppose there is an important overall dimension, I would say, in relation to non-performing loans. So I mean, the situation remains one of concern and high priority for the bank. I think the review shows non-performing loans levels now at just under 15%. This has been a priority for the bank and also for ECB banking supervision since it took over the supervisory role in November 2014. So our expectation, I would say, overall remains that this is a high priority for the institutions, that it must get kind of worked through, and that we want to see deliberate and sustained progress. And Ed might comment in terms of some of the emerging trends over recent months.
So we can see that NPLs have continued to reduce in Ireland over the last 3 or 4 years and are down very significantly from the peak in 2013-14. That's even more sharp in terms of decline in the SME corporate space relative to mortgages. And we certainly, as Sharon has mentioned, continue to push for progress to be made. In the specific question related to Brexit, at this stage we've seen no significant change in loan performance as a result. We continue to engage with banks on that.
Thank you. And Colin Kelpie again from the Irish Independent.
Can I just, a fair summary of what you were saying earlier to the overheating remark, is it fair to say that the economy is not overheating at present and the tools that you put in place will ensure that it won't overheat? Is that a fair assessment of what you're saying, essentially?
So I think I would just make a slight distinction. I mean, the bank, in terms of its mandate and responsibility, is around financial stability and clearly financial sector issues and so on. So I think to the extent that that's the area of responsibility, we don't believe that there is overheating. I mean, there is potential for overheating in other parts of the economy, and this is why I think this earlier discussion, the fiscal position, for example, is extremely important, as well as other dimensions. But I would say to the extent that we're looking at the issues in the macro-financial review and the spectrum for which we're responsible, we don't think the economy is overheating in that respect.
Thanks. And Sean Whelan again, RTE.
Just a follow-up to what Mark was saying about the house price valuations. Do you publish any information on how you calculate that valuation thing? Because a lot of punters would be interested
Yeah.
knowing
Yep.
whether they're paying too much?
Yeah, we do indeed. So as part of the background material to the review last year in November 2016, one of the technical papers related exactly to this. So first of all, we have a range of statistical indicators. This will be comparing price-income ratios, price-rent ratios to historical standards to other countries, and they both show that currently there's no overvaluation according to those. Secondly, we use econometric models which look at given where interest rates and incomes and other variables are, where we would expect the level of house prices to be. So I can give you the link separately, or communications can, but yes, we published this at the end of last year. We'll be updating the figures during the second half of this year.
Thank you. Is there any other questions? An opportunity again, Paul Calvin, Reuters.
I think you flag in the report that the infrastructure difficulties could have an effect on growth, namely housing being the obvious one, the deficit of infrastructure.
Yep.
It's also pointed out in the report that there's difficulties at the moment in terms of measuring household completions. Is how unsatisfactory or how difficult is it from your point of view when you're looking at how that's going to affect growth when we don't actually seem to know, no one seems to know how many houses are being built every year?
I mean, I think I mentioned it in the opening statement, so clearly it's an important dimension in understanding the housing market and understanding the pipeline of new houses that will come online, given that supply is such an issue in the market at the moment. But touching on what Mark said earlier, in terms of our analysis of the housing market and in the types of things that we look at as part of the review of the mortgage measures, we look at a very broad range of indicators, and I don't think you can just rely on one particular indicator to determine what might be going on, particularly given some of the complexities in the housing market itself.
Yeah, like there is some uncertainty given the fact that housing completions are measured according to electricity connections. But I think what we do know is that the overall supply of housing is well below demand requirements, and we also know that it is increasing, and that the forward-looking indicators point to the fact that it continues to increase at a reasonably strong rate. I think the increase last year was 20%. So we do have certain information on the dynamics in the market.
Any other questions? We're open to other questions? Okay. All right. Well, we remain at your disposal to answer any follow-up questions as you read the document, and our next publication will be the next quarterly bulletin. So look forward to talking to you again then. Thank you.